Welcome to Morning Brief. I'm Julie Hyman. Let's get to three things you need to know today. First up, Intel shares are plunging as its outlook falls short of expectations. The stock is also under pressure as it says it is struggling with manufacturing issues. We'll dig into the latest results and where Intel's turnaround stands. Plus, in the broader market, stocks are under pressure to close out a volatile week. The S&P 500 now headed for back-to-back weekly losses for the first time since June. We'll break down what's driving sentiment and the catalyst to watch heading into next week. And TikTok has finally closed the deal to keep operating in the U.S. The social app and its parent company ByteDance have officially established a U.S. entity to avoid a nationwide ban. We'll dig into what the structure of the new business looks like and what it means for U.S. investors. Let's get a check-in on stock futures, which are under pressure this morning. In part, we've got what's going on with Intel. We also have a number of other companies reporting, but all three major averages looking at a drop at the open. The Dow, a drop of about 0.5%. The S&P, about 0.25%. NASDAQ 100 futures pointing to a drop of about 1/3%. And as we have seen money come out of stocks, one of the places it has been going is into gold. We've got gold prices now pushing above $4,900 an ounce, and gold also looks to close out its best week since 2020. So we'll be continuing to monitor it as it gets closer to 5,000. Meanwhile, Intel plunging after issuing a weak outlook for the current quarter as it deals with supply chain issues, among other things. Our Yahoo Finance reporter, Laura Bratton, is joining me now with the biggest takeaways. Hey, Laura.
Hey.
So, Intel coming out with this disappointing forecast. What are sort of the most important things to know about what it said and why it was disappointing?
Yeah, so the biggest issues were just supply constraints. They're saying that it wasn't necessarily that demand was below expectations. It's more so that demand from AI data centers for their more traditional computer chips, CPUs, central processing units, as customers look to upgrade from older servers, they didn't expect it to ramp up as quickly as it did and as much as it did. And what they said is going forward in the year, they expect supply constraints internally to be the most pronounced in the first quarter and then to improve throughout the year as they improve yields, which is just how many functional chips you can get from a single silicon wafer. They use their tools a little bit better and just work to improve output.
Now, foundry is kind of the biggest thing that investors now want to know about. So Intel has a couple of different businesses. When we say they make chips, they design chips effectively. But then they also have this foundry business, which is them actually making the chips. That's the thing the prior CEO bet on. That's the thing Lip-Bu Tan is now trying to build out. And investors are waiting for more information on customers and who those customers are going to be. And we didn't get that yet, right?
Yeah, no. I think there's been a lot of hype leading up to the report. The stock was up like 46% leading up to the Q4 results. Analysts really didn't expect that they would announce a specific customer. There's been a lot of rumors that Apple will use their upcoming process, 18AP, which is just a more advanced version of the process they unveiled earlier this year, 18A. And also that Apple could use 14A, which is their upcoming process. 18A was initially supposed to be for outside customers, and they ended up just using it internally to make Panther Lake. And I think there was a lot of speculation that they wouldn't end up executing on an internal product with 18A. So customers had really held off. But now that Panther Lake has come out and has been successful, it's a PC AI chip. I think that's boosting optimism that they could get an external customer. And then also really what they need to do next is show that they can unveil a data center chip, Clearwater Forest, which is supposed to come out this year on 18A. So then, really to get to your question, they said 14A should have significant customer announcements potentially end of this year, early next year. But then, analysts noted that would mean that they wouldn't necessarily be ramping up production on that process until 2028, 2029. And one thing their CEO said is that they're not going to ramp up CapEx until they really know that they have a significant customer contract.
You gotta love the names of these things: Clearwater Forest,
I know,
Panther Lake, very zen. Nvidia goes with naming them after people.
Yeah.
They go with sort of natural names, which is interesting. Finally, I quickly want to ask about the memory chip situation, because as we know, there has been a spike in prices because there has been a lot of demand for memory chips, particularly memory chips tied to AI. How is that affecting Intel, if at all?
Yeah, so they didn't address it quite as much as I expected to in their earnings call, but their CFO did say that the memory shortage could, meaningfully affect their revenue this year. And the issue is more so that memory could affect the end demand for products that include Intel's chips. So, PCs and data center servers that have, that use a lot of memory alongside Intel chips, the prices for those products could go up, and then that could therefore affect Intel's bottom line as well.
Gotcha. All right, well, we'll be watching all of this very closely. We're going to talk much more about Intel throughout the show. Thanks, Laura.
Thanks.
Appreciate it. I want to bring in Kevin Mahn, Hennion and Walsh CIO, to talk more about Intel and the markets more broadly. Kevin, great to see you. Let's start with Intel here, because I'm curious. I mean, I would love to try and extrapolate Intel out to the rest of the industry, but it is has so many of its own specific issues, challenges, maybe opportunities. So I'm curious, as an investor, is it something that you're looking at, that you own? And if so, what did this report tell you?
Yes, we do own Intel in certain of our Smart Trust UIT strategies. And let's dive into that earnings report that you guys just covered. Let's start with the good. Just in terms of earnings, 15 cents versus 8 cents expected. That's about an 88% beat. That's certainly good. Revenue exceeding expectations. Now, they did disappoint on their guidance, but it's the reason that they disappointed, Jules, that I find somewhat encouraging, because they didn't have the supply to keep up with seasonal demand. Now, if they address those supply constraints and boost their manufacturing, remember all the three big entities that invested into Intel in 2025 gives them the capital to expend in those areas. This could work out well for Intel in the long run. However, they're playing a big role right now in trying to nudge into the foundry business. As we know, their biggest competitor in that regard is Taiwan Semiconductor. Taiwan Semiconductor, the largest dedicated chip foundry in the world, with about a 60% market share that boasts Nvidia as their largest client. So will Intel start to chip away and announce that one big anchor client as it relates to their foundry business? Or do they lean more into their chip business, which has always supported and been what Intel is known for? They're taking a risk and a gamble with that foundry business, but we need more competition out there. And if they have the balance sheet to support it, this type of pullback could create an attractive entry point. But of course, Jules, they're trading at about, I don't know, I'm looking at my screen right now, about 82 times forward earnings.
Yeah.
So they're still trading a bit rich.
Gotcha. So maybe you don't want to step in quite yet until we get more information, perhaps on that foundry business. Okay, so let's kind of zoom out then and talk about tech more broadly. We saw this sell-off happen this week. Tech has not done well thus far this year, right? And there has been, continued questions, even expanding questions about the AI trade. What's your current thinking there?
Yeah, my view is that we're still in batting practice of a doubleheader as it relates to the AI revolution, Jules. And batting practice involves all the additional infrastructure investment that we anticipate taking place, not only in 2026, but for the balance of this decade. Remember that Nvidia CEO, Jensen Huang, forecasted somewhere between $3 to $4 trillion spent on AI infrastructure investment. So the technology sector, those software and some of those hardware plays, I believe will be more volatile in 2026, especially those trading at heightened valuations. But more of the infrastructure plays, the data centers, the cooling solutions, the power solutions, that's where all the money's going to continue to be spent. And that's where I believe there's still growth opportunities as it relates to the AI trade.
And then something else this week, obviously, that we saw was the big sell-off, right, that was prompted by President Trump's Greenland threats and then sort of the bounce off of that. There was an interesting rift this week between retail and institutional in reaction to that sell-off. According to Bank of America, which cites fund flow data tracked by EFPR, we saw institutions, kind of sell on what was going on, but retail investors stepped in. And I'm curious about that rift and whether, buy the dip on Trump headlines. Has that consistently been a good strategy, and is that something that people should be doing?
Yes, tariff tantrum round 2, if you will, albeit much shorter lived in 2026 than it was in 2025. And I hope what I could glean from your statistics there is that retail learned a very valuable lesson from 2025. If we recall during tariff tantrum round 1, the S&P 500 was down about 15% through April 8th of last year. Now, had retail investors at that point in time fled the market and rushed to the sidelines because of that volatility, boy, did they miss out on a significant rebound as the S&P 500 rallied, about 39% from April 8th through the end of the year. So trying to time the market, as we always talk about, Jules, is an exercise in futility. What's more important is your time in the market, provided that you're invested with the diversification that meets your risk tolerance. So it seems as though, at least in this short period of time, that maybe retail learned their lesson from last year as it relates to tariffs, but institutional traders perhaps were looking behind those announced and threatened tariffs and maybe a little deeper in terms of other potential bouts of volatility this year, which I think are coming.
Yeah, well, okay, let's talk about those bouts of volatility then, because you, in your latest note, you give a lot of different candidates for triggering that volatility.
I guess start with.
Yeah.
Go ahead, Jules.
Well, I was just going to say, I guess the question is, do you just stay in the market no matter what?
I don't know if it's no matter what, right? Because you really have to be honest with yourselves about what your true risk tolerance is. In other words, if the market is moving higher, that doesn't necessarily mean that your risk tolerance should move higher, just as much as if it's moving lower, your risk tolerance shouldn't move lower. You should stay true to your risk tolerance, your investment timeframes, and what your growth and income objectives are. But with that said, think about what could cause more volatility this year. We know that the continuing resolution that was passed at the end of last year to fund the federal government expires at the end of this month. In all likelihood, in my opinion, the federal government may and will shut down again. How long will this next shutdown last? And then we have midterm elections coming up at the midpoint this year. We're going to have a new chair of the Federal Reserve coming in May. What's the outlook for interest rates at that point in time? What about the debt ceiling debate? What about the unknown nature, Jules, of the current tariffs that are in place, the Supreme Court ruling, and what may happen to the tariffs that have already been collected? A lot of question marks. But if we continue to get earnings growth, if short-term rates continue to move lower, if inflation continues to moderate, and if we get all of this CapEx spend continuing to take place, whether it's with respect to AI infrastructure, aerospace and defense, or even healthcare, I think those areas of the market continue to move higher and overcome those reasons for volatility.
Man, I'm exhausted just listening to you list all of those uncertainties.
Think about me. Think about what's going on.
I can only imagine. I can only imagine. Kevin, great to see you. Have a good weekend.
You as well. Thanks.
Coming up on Morning Brief, we'll bring you today's top trending tickers and dig into the details of TikTok's new U.S. entity. That's next. Now time for some of today's trending tickers. We are watching Nvidia, Capital One, and the airlines. Markets and data editor Jared Blickery is joining me now, and we keep getting this steady drip, drip, drip of Nvidia, China.
One way,
headlines.
the other.
Yes. So now it's mostly lately been going in Nvidia's favor. So there's some reports this morning that we're once again getting closer to Nvidia chips shipping.
Yes, and that just this whole thing has swung back and forth so many times. We could see another swing back the other way, and that could be on headlines from the U.S. or China. Right. But it does look like we have made some incremental progress here in terms of being able to sell Nvidia's last-gen products to the hyperscalers, and that's Alibaba, Tencent, ByteDance, and they are in competition, not only amongst themselves, but with the world in terms of AI and scaling up. So there's just a tremendous amount of demand for these products. And this is an in principle approval. Companies can still talk volumes and timing. And we just talked about the regulatory risks and geopolitics. So that could all play into this. It looks like the US side also matters. H200 exports are allowed, but we have testing plus caps. And so there are certain limits on the amount that can go through. And that's always subject to change. So we'll have to see. But this is a demand unlock for Nvidia. And as we've talked about in previous previous weeks here, this is not factored into their earnings just yet. It's getting factored into the stock price, because if we go to the Wi-Fi Interactive, I will pull up our semiconductor board. These are year-to-date returns, and what you notice is Nvidia's in the red. There's semiconductors so first tech has kind of gone sideways, but that's as chips have gone up and software has gone down. But within chips, Nvidia has really stayed kind of flatline there. So that's it's about 1% down. If we put on the pre-market quotes, let me do that there, you can see it's up about 1.32% right now. And I'll just pull the 1-year chart. Nvidia is kind of looking like a head and shoulders potential top. It would have to break the neckline there, but that would be a technical warning. And we've seen, this is a 5-year chart. Nvidia has moved in fits and starts, as most charts do. Nothing goes straight up. And so there have been long periods of consolidation, which have frustrated investors. But then once it gets launching, it gets to that next level. And so right now we're just waiting for a catalyst. This doesn't seem to be it today. I think a lot of this is getting factored in. So they're going to need a big new surprise, a demand unlock somewhere. I don't know what that is, but.
Well, and meantime, in the background of all of this, I was sort of fascinated this week to hear Anthropic CEO Dario Amodei calling selling AI chips into China like giving them nukes or giving nukes to North Korea. He basically thinks it's a bad idea. Obviously, Jensen Huang of Nvidia thinks it's a good idea, but it's interesting that debate that is ongoing.
Yes, and who knows if we're ever going to see another DeepSeek moment. I wouldn't, we could have some competitor come out of left field and say, these H200, we don't even need these. We can deal with something that's on a much lower scale. So we'll see what happens.
We will see, but it's fun to watch. All right, let's talk about Capital One. The stock is sliding following a big acquisition, expanding into the credit card space. It's buying Brex in a cash and stock deal for just over $5.1 billion. Brex's business centered mostly on corporate cards, expenses, and rewards. Obviously, Capital One is already a big credit card provider.
Yes.
They're just getting more into that business and on the corporate side.
Yeah, well, corporate is where the gravy is, because that tends to be a lot more stable. That's where the gravy is. So they want to get into that. And also the spend software. And also Brex has about $13 billion in deposits. And Brex has gone through a number of evolutions, as many startups have. It's been around since 2017. It was founded by Pedro Franceschi and Henrique Dubugras. And Franceschi is going to stay on as CEO. So there is some continuity there. So this is going to be a 50-50 cash stock deal, close in the middle of the year. 50-50 means that there's going to have to issue more stock in order to do this. And if we go to the Wi-Fi Interactive here, we can see it. And again, the background color is what's happened year to date. Almost everything is in the red here, except PagSeguro, which is not a U.S. enterprise. But so Capital One Finance there, down 3% for the year, down 3.79% in the pre-market. And I think that's just because this is going to cost some money and maybe investors need to see the synergies.
Well, also the earnings from the company were not great. Earnings per share missed estimates. The provisions for credit losses were up 57%, which is a big increase. And also in the background is obviously the threat from President Trump and perhaps Congress to cap credit card interest, which is the bread and butter of their business.
Yes.
Net interest from credit cards, by the way, last quarter for Capital One, up 64%. So it makes a lot of money.
There you go.
Credit cards. Let's talk about airlines. Carriers are canceling over 1,000 flights so far over the coming days as a massive winter storm makes its way across the United States. When you have these cancellations, obviously, there can be some sort of hit to the company's bottom line, depending on how long these disturbances last. And of course, we in the New York area right now, Jared, we're bracing for between 3 and 16 inches, somewhere in that very wide range.
Yes. So we have a lot of cancellations. I think FlightAware is counting 800 plus so far. I would expect that number to go much higher just because that's what tends to happen in history. But so this is, I think there are a number of potential choke points here. You got the hub airports, which we have a number of these in New York. De-icing capacity is affected. And so we're seeing this play out in the stock right now, not to a great extent, but if we go to the Wi-Fi Interactive one more time, I'll just point out that this is my travel heat map. And the pre-market, it's sorted by pre-market quotes. So at the very bottom here, we have Alaska Airlines. It's down Airlines is down 2.9% for the year.
I think Alaska also reported this morning or yesterday, if I'm not mistaken.
That could be a factor too. That's down the most, 3.25%. JetBlue down 1% in the pre-market. Southwest 0.9%. Same for American Airline, Delta, and United pretty close behind there. So we're seeing some nominal losses. But these kinds of events, they cost money. There have to be travel vouchers, there's the lost revenue, there's everything getting rescheduled, and so that's going to factor into, it's going to be adjusted because these are considered one-time expenses, but money's money.
And to your point about more cancellations coming, most of the cancellations thus far haven't even been in the Northeast or the East Coast. Most of them have been in Texas, Dallas, Fort Worth, et cetera. So
numbers going to go up.
Probably going to spread. Yes. Thanks so much, Jared. Appreciate it. TikTok has finally closed its long-awaited deal to remain in the U.S. The social media platform said its U.S. arm has been bought by several investors. That'll be led by Oracle. The deal brings an end to the years-long saga that nearly saw the app banned in the United States. So joining us for more, Yahoo Finance tech editor Dan Howley. Dan, okay, so if I'm an Oracle investor, what does this mean for me, or if I'm a U.S. investor generally?
It means basically everything is A-OK now. More or less, this is going to be the main question here is probably about the algorithm, right? That's the reason why people continue to use that. So they will retain the algorithm. However, it will be secured by U.S. companies, Oracle, and it will be they'll ensure that it doesn't have any kind of, outside influence, right? That was one of the fears of TikTok that came up in the first Trump administration, that it was basically, kind of a way for China to spy on U.S. users and influence them via the algorithm, right? And so now that became less of an issue when President Trump said that he liked it and then kept fighting the law that he helped get started to ban the app. Whatever. The main thing is that the algorithm will now continue to exist, but it'll have its own kind of U.S. flavor, I assume. Oracle's going to be securing all of this. The U.S. data is going to be under Oracle. They were already working with the U.S. and TikTok to previously ensure that U.S. data was separate, but the law was essentially ByteDance can only own less than 20%. And so that's where they're going to be. Susquehanna will own a portion, as well as a number of other investors. But really, I think for the most part, if you're looking to be invested in these companies or in this company, things are going to remain the same. They said they have 200 million people now. I think that's an updated number. They said 7.5 million businesses use it. And so this is, I guess, the end of a long national nightmare that didn't really need to happen, I guess. It's all rather confusing.
Long national nightmare, I guess, if you're on TikTok, I suppose. All right, let's talk about another tech story you're watching. Amazon is starting its job cuts. They were previously announced, but there are reports here this morning that they are beginning. And this is concentrated in corporate, right? This is not warehouse workers and such.
No, these are the white collar positions that Amazon has. The big thing is, back in October, there were layoffs. Reuters had reported then that they were looking at to cut a total of 30,000 jobs from the white collar workforce. And so now Reuters reporting that on as early as next week, they'll make additional cuts to to reach that number. They had previously cut 14,000 positions, so they still have a number to go before they reach that goal. And so we could see it as soon as next week. They report earnings on the 5th, and so we'll probably see them do the cuts and then give some kind of explanation as to where they were related to or what the reason for it was. As part of the actual earnings call. The original thinking was that this was a result of AI, and then Andy Jassy, CEO, had said, kind of not really, on the earnings call, basically saying, that it wasn't even necessarily related to AI, but more of a culture issue. And really, there's been this ongoing discussion in Silicon Valley about flattening, which is the way they basically say firing middle management. And they basically have all kind of come to the conclusion that there was too much bureaucracy within their companies, that things were moving too slowly, and they wanted to speed up decision making. They potentially overhired during the pandemic. That was a lot of things. One of the things that a lot of the companies did. I think at that point they all thought that everyone was just going to stay remote forever, and so they hired up. And now they're all realizing they don't necessarily need that many employees, or they're looking to save, on the bottom line. And so that's really where these cuts are kind of going to be focused on, saving these companies some money, but at the expense of folks' jobs.
Right. Yes. Well, we'll keep watching what's going on there. Dan, thank you. That does it for Morning Brief. Opening Bid and Brian Stasi are next.